everyone, welcome to the 12th episode of Dollar Dialogue. Today we're here to talk about another very interesting topic with another special guest speaker. Our topic of discussion for today is the art of value investing in 2024, stocks, bonds, and beyond with Raffaele Maria Valensise. He is a very dedicated economics student. He's a very dedicated finance student. He's a very knowledgeable guy that I know. He's currently a rising senior in an Italian school, in an Italian classical school. He is also very a hardworking person that I met, and he's very passionate about finance, everything that's related to finance. He's currently working at a Italian firm, and he's currently doing internships, so which highlights his dedication to the field of finance. And he's just a great guy to work with and to be with, and he is one of the most, I would say, the most successful value investor for our age, for our age. If you're a teen, he's probably one of the most successful and most dedicated value investors. So, Rafael, is there anything that you would like to add to the introduction?
Well, first of all, Arif, thank you very much for having me here. And no, I think it was good. I mean, I just turned 18, and that means it's not really a lot of time that I've been investing. But I'm really passionate about finance and about strategies, especially all the key investment strategies that we have studied also together throughout not only our summer classes, but in general in our free time. And so yeah, I'm really happy to be here and to participate with you guys.
All right, let's move on to the topic of discussion for today. Again, our topic of discussion is the art of value investing in 2024, stocks, bonds, and beyond. So let me first start by defining what value investing is, because a lot of times what I feel like is that people can't distinguish between investing and trading. So there's also a very large, you can say, difference between investing and trading, because even the people who are not, you can say, interested in finance, they think, oh, investing and trading are the same thing, but it's not. Trading is something that's it's to profit from short-term price movements in financial instruments, while investing is to build wealth over an extended period of time by purchasing assets that you expect to increase value. For trading, you just see a price and it's rising, you think, oh, let me buy it, and let's hope it goes on a little bit more. While investing is making sure that you buy assets that you actually believe in and that you think it's gonna rise in value over the future, and it's basically building on wealth. And while trading is very short term, it can be from a few seconds to a few days, while investing is usually long terms for from over 12, more than a few months to over many years. Now let's start a little bit and talk about what's value investing. So what value investing can be defined as is it's an investment strategy that involves picking stocks that appear to be valued for less than their intrinsic or book value. And this practice is used by renowned investors like Warren Buffett, and I think Benjamin Graham also added a bit of what value investing is through his book, The Intelligent Investor. And a very key principle of value investing is margin of safety, which is buying securities or buying financial instruments at a price below their intrinsic value to limit downside risk and to provide a cushion against errors in analysis or market downturns. So basically, in simple words, value investing is basically finding companies that are undervalued, and basically finding companies that are undervalued, and you buy them in hopes of it matching its value in the stock market in real life. And obviously the market environment in 2024, we have to also talk a little bit about that. The economic landscape, the global economies are now stabilizing after the disruption caused by COVID-19 that is leading to varying recovery speed across regions. And now it's a very, you could say, a special era because of AI, blockchain, and renewable energy, which are shaping our future and shaping industries and shaping everything. You could say that. And now central banks around the world are also managing high inflation and influencing monetary policy and interest rates. And there's also, which is very unfortunate, there are also a lot of trade wars, political instabilities, and regional conflicts around the world that are contributing to market volatility and uncertainty. So this is what the current landscape is in 2024 for investing. So is there anything that you would like to add to the introduction that I just said? Arif, Malik, Shazib Karim, or Rafael?
Okay, guys. So if you want, I can add something from my perspective and from my experience. So when we talk about value investing, I really love recalling this, I think, Warren Buffett quote, which is price is what you pay and value is what you get. And in this case, in this scenario, I think this quote is really applies because when we talk about value investing, we actually trying to measure the underlying value behind, let's say, a stock. But of course, what is value? It's a really hard concept to try to define and even to calculate because not even analysts from the internal part of a company can actually sometimes even estimate what the real value of the company's share is. Imagine for a normal investor like us. And for the value investing and in general for investing, one of the most used and most popular models is the DCF, right? So the projection of future free cash flows, which are then being discounted by the WACC. But even in this case, how can really an investor define what will be the growth, the potential growth of a free cash flow of a company, and what's its appropriate WACC? So these are some of the, we can call them, intricacies of value investing, which of course not only stems and includes the margin of safety, but includes what's called the fundamental analysis, right? And with fundamental analysis, of course, you need to have a really strong background because sometimes companies may, hide some numbers, hide some costs, and then even change some numbers from the real ones. And that, of course, is the part which gets a little bit tricky. For example, we all know one very important metric that investors typically look at, which is the earnings per share. But of course, it's even important to underline whether the earnings per shares, the EPS, are diluted or non-diluted, because of course this number can be highly manipulated by the numbers of shares outstanding. And so I would say that value investing can be defined even as the core of investing and of all the other investment strategies, because as you guys probably know, we have then what is defined as growth investing. We have also the social investing. And so when investors actually look at, for example, ESG criteria, and that, of course, is another type of investing. But I think value investing is really at the core of this whole bunch of this whole categories because of its real scope and real purpose. And so to buy an asset now, which is undervalued, and to try to keep that asset, to maintain that asset without selling it off for any reason for basically your life.
Yeah, Rafael, well said. And to just add on to what you said, I think like talk about this topic. Another major trend in 2024 is the continued rise of sustainable investing. ESG, environmental, social, and governance criteria are not just buzzwords anymore. Companies with strong ESG practices are showing better long-term performance and resilience. And as you know, investors are increasingly prioritizing these factors, not only for ethical reasons but also for financial returns. And I think to discuss this topic further, we can we can also talk about how ESG investing has evolved in 2024, and we can see that ESG investing has matured significantly. More data and better analytics are available, making it easier to assess companies, and investors are looking beyond just greenwashing and focusing on tangible impacts. For instance, renewable energy projects and companies with strong social initiatives are attracting a lot of attention.
Shazib, yeah, I agree with ESG here, but like I would like to talk a little bit more about the history of value investing. I think Araf touched a little bit on it. So like value investing was actually, I think was traced back to Benjamin Graham and David Dodd, who were professors at the Columbia Business School, and they basically laid out the foundation of value investing in the books called Security Analysis. I read this like during COVID, and like this completely changed my perspective on investment. And like I would urge the viewers to read this book as well, because security analysis talks about some of the concepts such as intrinsic value and the importance of margin of safety, something that Raffaele has talked about. And I think the margin of safety is a principle which suggests investors should buy securities at a significant discount to their calculated intrinsic value to protect against the errors in the market or in the unforeseen market turn downs. And I would say like this value investing, like it's a strategy, like it's a long term strategy. Like most people think like they can make profit in the stock market by day trading, and even though that might be true, in the long term, value investing is where is it at? Because like some of the world's most successful investors, like Warren Buffett, they're actually like he was actually a student of Ben Graham, who was one of the pioneers of value investing. So like this truly shows like value investing's like at the heart of the stock market and at the heart of investing is value investing, because this involves a comprehensive examination of the company's balance sheet, financial statements, and income statement, and cash flow statements as well. And this allows the investors to pretty much analyze the company beforehand and invest on it. And I think discounted cash flow is a way to do it. And one more thing that I would like to talk about that we should like maybe prioritize here is the contrarian approach that most value investors have. Like I would say most value investors don't follow the market as often as people might assume, and most value investors actually seek opportunities in stocks that are actually out of favor in the market right now. Like these stocks are undervalued due to their maybe negative market sentiments or broader economic concerns, and basically we value investors want to find these bargains and ultimately make a profit off of it. So would you guys agree like that value investors are actually contrarian, and like we don't actually follow the herd, instead we actually follow the opposite direction in most cases?
Yeah, I'd actually agree with what you said. It's pretty interesting, and I'd say I fully agree with you.
Well, yeah, I also agree with you, Arab, also because most of the times another important thing that investors should look at, apart from maybe the most outperforming stocks and the one that instead are not performing, and that of course is a critical thing to look at, a critical indicator to look at. I think another let's say red flag that investors should try to look at is the management, because most of the times investors tend to look at basically what the numbers are, if there are more cash inflows than cash outflows, so if their revenues are growing exponentially. But what most people forget is that the most even important part of a company, maybe saying the most important is not really appropriate, but a really critical component of a company is its management, its board of directors. And so knowing who then is going to manage your money, because if you're both an equity investor, so if you're financing the company through equity, or if you're a debt holder, so you own a corporate bond, you're giving your money to them. In case of a bondholder, you're lending your money. But basically, you need, of course, to know who you're lending your money to, who is taking care of your money while you're being invested in the company. And so even having a look at the management, and maybe about the management performance over the time, about the management even, let's say, professional career, that is a good thing that you should actually focus your attention on. What do you guys think? Do you think as value investors this is as important as even analyzing the numbers?
Yeah, Rafael, like continue.
No, I go.
Oh, okay, thank you. Yeah, so like I actually agree with you here, because like if the company is the ship and the management is actually the captain who's leading the ship, and because of this I actually agree with you. Like numbers speak volumes, but at the end of the day we have to know who's actually controlling the company. And because of this, like I don't know if you guys have heard of the Porter's 5 rules of analysis. Like it's similar to value investing, in which Porter, who is actually a very successful investor, he looks at he not only looks at the holistically the company, not just based on financial metrics, but also looks at the management, and he emphasizes more on the management, because management is at the end of the day what's gonna increase and boost these financial metrics that of these companies. But I was actually like wondering, like oftentimes when I invest in companies, like manage, like it's like I go to the company's website and possibly look at the management who's leading the companies, but like would you guys often say like it's hard to actually know what kind of CEO or like what kind of board management is leading the company, and like I wanted to know, like, I'm curious, like, what do you guys use? Like, do you have any particular website or like any other sources that you use to analyze if the management of a company is actually good or not? So I think those are very interesting, interesting concepts that have been brought up. For example, like I agree very much with Rafael and Arif that when you look at a company, it's very important to look at the people who are running the company, because at the end of the day, it's the people who are going to produce that numbers. The numbers are not going to just show up because a robot did some work. It's the people who run the company. It's the leadership behind the company that produces that number, and that has the impact on the stock market or the stock price and at the company itself at the end of the day. And I think it's very important to look at the company overview and the people who are running by the company. And as for Arif's question about how can we decide whether the company's board of directors or the company CEO is in a way you can say a visionary leader, or it's a hardworking leader who's going to take the company forward. I think it's very important to look at their past performances. For example, if you look at, for example, Nvidia, the CEO of Nvidia, Jensen Huang, if you look at his past performances, he basically took a company that he founded to something that's worth that now is worth over trillions of dollars, and that has a very real impact in the AI sector. And so, if you look at Nvidia CEO, you can easily say that that's a very strong leader, and that's a leader that you can trust. At the same time, you can also say the same thing for Apple. The Apple's CEO, who has been running the company since Steve Jobs died, he's a very, you can say, visionary leader, Tim Cook, because he also took this Apple company, and Apple was already a very established company in 2011. I think everyone can argue with that. But he took Apple, he made more technological improvements, and he made that company better. He made that bigger. He expanded. And so you can also say that, Apple has a very good leadership, because that company is increasing. That company is increasing, and it's improving daily. And another thing that Rafael brought up at the start of the discussion is about discounted cash flow. I think it's very important, because discounted cash flow uses projects future cash flows based on historical performance and growth estimates, and that's something that I totally agree with. The best way to predict whether the company is gonna increase, is gonna produce more value in the future, and is gonna have more revenue in the future, is by looking at its past performances, and using the discount rate also to calculate the present value of future cash flows also reflects the time value of money and risk. But another thing that Rafael brought up that I find is very important in this era is making sure that the numbers that are produced, that you can trust them. For this reason, I think it's not obviously, we as investors, we as people who don't are outside of the company, we cannot say for certainty that the numbers that the company has given us is true. But I think it's also the role of regulators such as the SEC in the US, and in Bangladesh we have also our regulators in Italy. Obviously, Italians have their own regulators. I think it's the job of the regulators to make sure that the companies are producing the factual numbers, actual numbers, and if they don't, they're penalized heavily. And a very recent allegation against one of the biggest companies in India, Gautam Adani's company, is that he has been producing fake numbers and all those things. I think it's very important that regulators penalize and punish the people who produce fake numbers, because at the end of the day, those fake numbers are harming investors, they're harming the stock market, and they're making the market less efficient, and they're also scamming people, they're manipulating people's money, and they're harming people in general. So I think Rafael has brought up a very interesting point.
Yeah, and I think to add on to what you guys have been saying, obviously it's crucial for to know who runs the company, and it's crucial to have a good leader, because leaders with a proven history of success are more likely to steer the company towards growth and profitability. And effective leaders make sound decisions that can significantly impact a company's performance and strategic direction, like what we've already talked about. And to just talk more about it and just give some examples, like if we look at Facebook and Mark Zuckerberg's leadership has been instrumental in Facebook's growth from a college networking site to a global social media and technology giant. Even though it's not used as much as it used to be, but we can still just look at this and just understand how crucial it is to have a good leader who's capable to steer the company in a successful manner. And his focus on innovation and strategic acquisitions like Instagram and WhatsApp has expanded his company's reach. However, his leadership has also faced scrutiny over issues like data privacy and misinformation, showing the dual impact a leader can have.
Also, guys, I had a question for you because, for example, when looking at a company's financial statement, most of the times it's pretty hard to calculate by your own self the free cash flow, which at the end of the sale, at the end of the story, is basically what is left for equity and for debt holders. Most of the times, what I would like to see in a company and what I believe value investing should also be about is seeing how the company manages its, of course, earnings, and how the companies tries to reinvest most of the earnings to stay in the business. Because unfortunately or fortunately, I don't say this, depends on the point of view, but nowadays we live in a tech world. So basically every company needs to stay every year and maintain or even improve its, let's say, R&D, and this is because they need to they spend a lot of money on research, since they need to keep up with all the for example, when ChatGPT went out, a lot of companies started to invest heavily on AI, and this is basically what will happen also in the future, and what it has always happened, especially in the tech sector. So what I want to know from you guys is how much in, let's say, a tech company or even in other companies do you pay attention to, for example, their payout ratio? Because in my case, I would really prefer a company reinvesting most of its profits in the business and in even researching and developing their products, rather than just distributing their earnings in form of dividends to the equity holders. Like, I understand that that's a sort of rewarding way to distribute money, and most of the times managers tend to give out earnings in form of dividends, because maybe there are no really good prospects for the company. And so how does that, in your vision of a company, impact? Because do you regard this as a signal as, oh, maybe the company doesn't see really some good and profitable growth prospects, or maybe do you only think it's part of the business and it's just a way that the management decided to reward its holders, its equity holders?
Yeah, Rafael, I think that's a very good question, and I would say low payout ratios aren't necessarily bad, but I would say it depends really on the industry that we're analyzing. Because in the tech industry, for example, I believe except for Apple or Meta, or Apple Meta, or or other companies, I don't think they really pay out dividends, and the payout ratio is extremely low. If you look at Amazon, for example, Amazon, if I'm not mistaken, Amazon actually doesn't pay that any dividends at all, and actually they reinvest most of their earnings into the R&D and into their logistical businesses, and an ideal payout ratio, I would say it's a very difficult thing to point out, because it varies by the company's life cycle and the industry. But I would say for tech companies, when I'm analyzing tech companies with Shazib or Araf in our finance club, we actually look for a lower payout ratio. If it's less than 10%, it's actually our benchmark, because we look for low payout ratio in tech companies, because we actually, like you said, we actually want them to reinvest all of their earnings into the business. And even though it might not be ideal for dividend shareholders, but I would say that's actually good for the tech companies, because tech companies are in an industry where research and development is quintessential. And I would say extremely high payout ratios for tech companies is a red flag for us, because if they're paying so much dividends and earnings to investors, it's not really sustainable, and the growth of the firm is not really that high. And I would say for tech companies, to answer your question, we look out for low payout ratio. But for other companies such as banking, those are in the banking sectors, or those are in the consumer sectors, like JP Morgan or JP Morgan, we actually it's a company that we analyze, Like we actually in the banking sector we look out for higher dividend, but in industries, growth industries, for example, a low payout ratio is ideally under 10% is preferable for us. So Shazab, would you like to comment on anything regarding the low payout ratio?
Yeah, I'd definitely like to add on to what you said, Arif. So to just talk about this question that you brought up, Rafa, it's a very interesting one, and it's a very good question as well. So when we're looking at the payout ratio, and when we're looking at the importance in tech, and I'd say that many tech companies, especially those in growth phases, reinvest most of their profits back into the business rather than paying high dividends. And a lower payout ratio can indicate focus on growth and expansion, like what Arif said. That's why we look for a lower payout ratio, so they focus more on their growth and expansion of the company. And for more mature tech companies, a reasonable payout ratio can indicate financial health and the ability to sustain dividend payments. And to give some case examples, for example, if we're looking at Apple, right? Apple has historically maintained a moderate payout ratio, balancing dividend payments with significant reinvestment in new products and technologies. And Apple heavily invests in R&D to innovate its product lines, and it also uses profits for share buybacks, which have significantly boosted shareholder values. And for to give another case example, if we look at Microsoft, for example, Microsoft has a moderate payout ratio as well as Apple, and this reflects Microsoft's mature status and stable revenue streams. And Microsoft uses its profits to invest in cloud computing, acquisitions, and R&D in emerging technologies like AI and quantum computing. And it also has share buyback program that returns value to shareholders.
So yeah, I agree with Shazib and Arif and about the question that Rafael had asked. Now let's talk about a little bit about the key ratios that investors might use while deciding when to choose a company or how to choose a company during value investing. For example, we have different ratios such as price to earnings, which measures the current price relative to its peer share earnings, and we have the price to book ratio, such as which compares the book value, market value to the book value. We have the debt to equity ratio, which evaluates financial leverage and risk. Then we also have the return on equity (ROI), which measures profitability and efficiency in generating returns. And we also have the earnings per share (EPS), which is an indicator of our company's profitability. And we also have the financial statements. We have the income statement, the cash flow statement, and we have the balance sheet. And I think it's very important to look at the company's income statement to see whether they're actually producing revenue or not when choosing a company for value investing. It's also, I think, very important to look at the balance sheet where seeing whether the current assets of the company are greater than the current liabilities, to make sure the company's not going bankrupt. And I think it's also very important to look at the cash flow statement to see how much free cash flow the company has at the end of the day, to make sure after paying all of the operating expenses and after paying everything, they're actually making some money at the end of the day. So what's your opinion on that? How should one look at the cash flow statements and the key ratios when value investing? Raffaele, Arif, or Shazib?
Okay, so for me, ratios are important because, of course, they give you an immediate snapshot of the company. And however, as we were saying before, ratios are not everything, because when you look at the financial statements and in general at the reports, the financial statements represent only a small fraction of the total report, because what you're going to see on the annual report then is all, for example, the problematics that they had throughout the year. You're going to see all the strength points, but also all the risks that are inherent of the company. So when you're deciding whether to invest in a company or not, you should pay attention to that as well. But as we were saying before, numbers still count a lot in especially investing, and especially now. So another certainly metric that I would look after are the margins, and this is because when applying this concept to value investing, it's critical for everyone to know how much does a company need to pay in order to produce a certain product, and what's the margin that the company earns on that specific product after having paid, let's say, all the salaries and after having covered all its costs. And so, for example, a really useful metric in this case is, of course, the gross margin. But also another Another metric which stems from what we have said before is the ROIC, so the return on invested capital, which is also a valid alternative for the more complete ROCE, so the return on capital employed. And these two metrics are critical because, as we were saying before, they give us evidence and evidence-based on how the company is reinvesting all its free cash flows, and so how much the company is willing to, first of all, get, and so first of all, let's say how much the company gets as a return from its investments, and also, all the problem that we faced before, so regarding the payout ratio and the dividend payment or not. And finally, one last thing about this important metrics. I think that in value investing, we should look mainly at what are called compounders. And so compounders are companies that have been growing their, let's say, revenues. We can even take as an example the EBITDA, and so their operating profit, their net income, their free cash flow. And so companies that are progressively growing have been growing these numbers. And this is crucial because, first of all, it gives us a clear measure of how the company is performing throughout many years, because always remember, if you're a long-term investor, you should look at many years before and even many years ahead. And second of all, it's important to look for compounders because, for example, during COVID, of course, a lot of companies have lost revenue. A lot of companies have even gone bankrupt. But there are still some companies that have managed, however, because of their management, because in general of how the business they operate in is made and is structured, they managed to report a higher growth in the revenue than the year before. And so the growth and the aggregate growth in, let's say, a 5-year period or a 10-year period is also a crucial metric when analyzing companies. What do you guys think other metrics are? For example, what do you guys think about the cash and the debt levels?
Yeah, just to add on more to what you said, I think another important ratio I personally believe is the debt to equity ratio, which can be which means like this ratio indicates the relative proportion of shareholders' equity and debt used to finance companies' assets. And for tech companies, maintaining a balanced debt to equity ratio is crucial to support growth while managing financial risk. And I think another very important ratio would be the price to earnings ratio, right? Because the price to earnings ratio helps assess whether a stock is overvalued or undervalued by comparing the current market price to its earnings. And in tech companies, high price to earning ratios often reflect high growth expectations from investors. And I also think capital expenditure to sales ratio is very crucial, and it also indicates a lot of signs as well, because this ratio indicates the level of investment in capital assets relative to sales. And in tech companies, high capex to sales ratio can significantly can signify significant reinvestment in infrastructure, technology, and innovation, which is crucial for long-term growth. And if we look at the application of ratios in tech companies, we see that in tech companies specifically like Apple, we see that Apple used the ROI, the return on investment, because Apple's significant investments in product innovation like the iPhone and Mac have yielded high ROI, showcasing the company's ability to generate substantial returns from its investments. And not only that, they also used ROE, because Apple consistently has a high ROE, indicating efficient use of shareholder equity to generate profits. And to look at another example, we can also look at Microsoft, for example, and they use EPS growth because consistent growth in EPS reflects Microsoft's strong profitability and ability to deliver value to shareholders. And even Microsoft utilizes ROE because Microsoft's high ROE demonstrates its effective use of equity to generate strong returns, driven by its leading positions in software, cloud computing, and enterprise services.
Shazib,
and like to answer Rafael and Arav's question, I would say like all of these like financial ratios and like metrics, I believe are important. But I think at the end of the day, like yeah, I think it ultimately comes down to the industry that we are analyzing, because I think like it depends, the financial ratios actually depend on the industries and not actually on the company, on the companies itself. Like it's an approach that I have taken, because I think like in the technology industry, for example, we might prioritize the the price to earnings ratio to see if the tech company is overvalued or if it's undervalued, or like the or like the or like the price to sales ratio, in order to see if the company is useful in in evaluating growth companies that may not be yet profitable, as it focuses on the revenue generations rather than the earnings. And like I would say for tech companies, that's usually the ratios that I look at. But for financial companies such as JP Morgan or JP Morgan Chase or Morgan Stanley, I would say the net interest margin, which is basically the difference between the interest income generated and the interest paid to lenders, is probably the most important financial ratio used to analyze the companies in the financial industry, as it reflects the core earnings capacity of the bank's lending operations. And for like retail industry like Walmart or Home Depot or Target, we might use the gross margin. I think Rafael talked about gross margin because it indicates the core profitability of a business before the operating expenses. So yeah, and like overall, I would say like it depends at the end of the day. In fact, I had asked a similar question to one of my professors last year at Columbia, like during a stock market competition. I was like, Professor, which financial indicator do I use? Like there's so many. Like which one do you recommend? And he just looked at me, and he just told me just use Porter's 5 rules. He told me Porter's 5 rules is basically one of the strategies developed by Porter, and his full name, I believe, is Michael Porter. He was a professor at the Harvard Business School, and he developed the 5 forces of framework in his book, which I think is called Comparative Strategy. He talked about threat of new entrants, power of suppliers, power of buyers, threat of substitute, and rivalry among the existing competitors. So basically, like using these 5 forces, we can actually analyze if the company is actually if it's actually worth long-term investing. So yeah, like I would say like metrics, financial ratios differ industries to industries, but at the end of the day, it ultimately comes down to the fact that if the company is delivering product that is a necessity good, because I believe that companies that deliver necessity products, such as those in the pharmaceutical companies or those in the retail companies, will be more sustainable as opposed to tech companies at the end of the day. So what do you guys think? Like when you're investing in companies, do you actually look for companies that are actually producing necessity goods, or those are actually like tech companies where they're more where there's more rivalry, and their products could easily be overpowered by another new companies?
Okay, so if you want, guys, I can sort of try to answer to our question, and then I'll pass the ball to you guys. Well, so I think that when we talk, we have been discussing about value investing, but at the end of the day, in most cases, value investing also stems from ESG investing, because when we look at the companies that we think may be profitable in the future, we also need to account for all the SG ratings and all ESG problematics. And this is because companies who are not sustainable in the long run will fail. And having also looked at the various industries, Arab, you made a really good point, because of course using the same financial metrics and the same financial percentages and multiples for every company you analyze, it's a mistake, because of course each industry, and if you have even a broader view, each sector has its own multiples to use, its own numbers for specific ratios and all the stuff related to numbers. And so it will be you will be a fool to compare let's say a company who works in the rate industry and a company who works in the tech one. And so in conclusion, what I just wanted to say is that when looking at a company, first of all, you need to try to frame the industry the company is operating in, and so what the business is all about. And then if you're good enough and if you can read through the numbers, you should have, of course, like you must have, if you're operating at a really high level, a look at the numbers. But most importantly, also, you need to think about the qualitative aspect of the company. And so just by thinking generally and not even going inside the balance sheet, the statement of cash flows and things like this, like what you really need to realize is the business, like the business will be sustainable in the future? Isn't the business going to be sustainable in the future? Isn't the business going to be, consistent with this shift towards tech, towards energy, and towards all ESG problems and related issues? And this, of course, gives you, a broader view of the company, which at the end of the day is what counts the most, apart from the metrics and all the numbers that you may see on the annual report.
So I believe that the opinions that have been shared are extremely important, are extremely crucial when value investing. And I think all the information that we have shared primarily applies to stock. I also want to keep a little bit of time to talk about other forms of value investing that can be, because I believe that a lot of emphasis is put on stocks while overlooking other sectors such as bonds and other such areas. For example, now let's talk a little bit about bonds. Like, for example, we know that, and this is a fun fact that I learned, that the bond market is bigger than the stock market. Not a lot of people realize that, but that's true. That the bond market is bigger than the stock market, which can also highlight the more opportunities that are present in the bond market. So let's talk a little bit about bonds. So we have like different types of bonds, such as government bonds, which are issued by national governments and typically are considered low risk. And from the US, in the US, there is the T-bills in Bangladesh. We have own version in Italy. Obviously, there's their version, and we also have the municipal bonds, which are issued by the local government and that are often tax exempt. And I believe that municipal bonds in Bangladesh, we don't have those because we are not a federal republic. We are a unified republic, so we don't have those. But in the US, they have it, and I believe in the Italy also, because it's divided in different regions, they also have it. And then we have the corporate bonds, which are issued by companies offering high yields with higher risk. And then we have what people call high yield bonds, but a lot of times people just refer to them as junk bonds, which are issued by companies with lower credit ratings and which are offering high yields to compensate for higher risk. And while looking at the bond market, it's very important to look at the relationship between the bond yields and the maturities. And we have the normal yield curve, which indicates economic growth, with longer term bonds having higher yields. And then we have the inverted yield curve, which may signal an upcoming recession with short-term bonds having high yields. And when looking at bonds, it's also very important to look at the credit ratings of different companies, such as which are companies and credit rating agencies often assign a credit rating to companies to risk their rate of default. For example, S&P, Moody's, and Fitch. And then we also have the interest rate risk, because bond prices inversely are related to interest rates, and the measurement of the bond sensitivity to interest rate changes with longer duration, including higher sensitivity. And then we also have the treasury inflation protected securities, which are most common in the US, which are government bonds that adjust principal based on inflation, protecting against inflationary risk. And I believe it's easier to talk about bonds than it is easier to talk about stocks. But one of the things that I would like to discuss a little bit is about the credit ratings, because a lot of times when people invest in a bond market, they look at the credit ratings and see whether the company that they're investing has a high credit rating or not. But as you may know, that the credit rating agencies, such as whether it's S&P Global, Moody's, or Fitch, they sometimes assign credit ratings to companies based on their relationship with a company. For example, I forgot what was that company's name, Bed Bath and Beyond. They went bankrupt, but they still had a very high credit rating, and it highlights that the credit rating might not be accurate many of the times, because the credit rating agencies have a good relationship with the company that they're rating. So what's your opinion on that, Arif, Shazib, or Raffaele?
I think you brought up a really good topic, and because we know that value investing is not all about stocks, right? So I think you brought up a really interesting topic, talking about bonds, and I'd say that there are a lot of key concepts in bond investing, and to just talk about one is the credit quality, and the credit quality of a bond reflects the credit worthiness of the issuer, and it's typically rated by agencies like Moody's, S&P, and Fitch. And the importance of this is that bonds from issues with a high credit ratings are considered safer but offer lower yields, whereas lower rated bonds offer higher yields but come with higher risk. And and so, if we also look at the value investing in bonds, and if we look at the strategies for value bond investing, there are a couple of strategies used. For example, the laddering strategy, which involves buying bonds with different maturities, and it reduces interest rate risk and ensures steady cash flow. And another strategy is the barbell strategy, where you invest in short-term and long-term bonds but avoid intermediate-term bonds. And this strategy balances the higher risk and potential returns of long-term bonds with the safety of liquidity of short-term bonds. And there are other forms of value investing as well, but now we're focusing on bonds. So yeah, that. So would you guys want to add anything else?
Shazib, like it's an interesting thing that you mentioned about like value investing, particularly when looking at the bond market. Like most people actually like when they talk about the bond market, like actually there's a interesting correlation if you guys haven't noticed. Like usually when the stock market is up, the bond market is usually down, and inversely when the bond market is usually up, the stock market is usually down. And it's one of the things that I believe Benjamin Graham wrote in his book of value investing. And this is why I'm very passionate about talking about bonds, because like I believe those who are not particularly those are not those who are like amateur and not are getting started investing in any of the financial markets, whether it be stocks, crypto, or forex. I would actually recommend them looking at bonds, because bonds are actually way more easier to understand and to deal with. And one of the main strategies that I would say, like what I would say, it's simple. Like analyzing bonds is really simple. I would just say I believe bonds are graded based on letter grades such as A, B, C, and I think Moody does a great job at like giving out those grades. So basically, people can just look at the grade quality of the bonds and then accordingly invest. And it's simple as that. Like obviously there might be some risk involved, such as there might be risk involved, and but at the end of the day, I would say like key strategies in the bond market ultimately depends on the letter grade. And another thing that I would like to mention, if I don't know if you guys have heard about Ray Dalio, but Ray Dalio, who's the founder of Bridgewater Associates, and he's known for his all-weather portfolio. And in his all-weather portfolio, he actually talks about his strategies, which include significant bond exposure to achieve diversification in a strategy other than stocks. So one of the strategies that Ray Dalio uses for buying bonds is actually he looks at the inflation of the inflation, and in order to protect the bond from inflation, his portfolio actually includes inflation-linked bonds, such as the TIPS. I believe it's called the Treasury Inflation Protected Securities. The U.S. government releases it, and it's basically one of those bonds. Like regardless of the inflation rate, regardless if the inflation is super high, I believe in the U.S. it's slowly coming down. It's around 3%, I believe, and because of this, you can safeguard your bond against the inflation eroding the real value of the bonds fixed income. And lastly, I would like to talk about one more strategy. Like I'm sorry, I'm passionate about bonds, and it's actually developed by Mohammed El Erian. He's the former CEO of PIMCO, and he's known for his insights regarding bond investing. And I would actually recommend you guys actually look at the listeners as well to the concept of new normal that Mohammed actually developed against the higher volatility following the 2008 financial crisis. So briefly, this is also an interesting strategy to invest when you're investing in the bond markets. It's basically Arian adopted a global macro perspective in bond investing. He analyzed the economic conditions of the country, the policy decisions, and the regions to identify investment opportunities. And this flexibility is a cornerstone of Mohammed's strategy. And ultimately he highlighted the importance of investing in high quality bonds. Like high quality bonds might not necessarily give higher returns, and lower quality bonds usually have higher risk but high returns. So Mohammed, at the end of the day, told in like in his conclusion, he talked about buying bonds specifically from the government, not necessarily company bonds, but buying these bonds at a lower rate, but at least ensuring that you are safe from the global economic recession or the global financial crises and such. So yeah, like Rafael or like Shazib or Araf, like would you guys agree like the bond market is, I would say, like particularly friendly towards novice investors, and like the strategies are relatively simple. Like if you like study bonds for like a month or two or so, I would say you would be relatively smart enough to possibly invest in a demo account. So would you guys agree with me here?
Yeah, I would agree with you. And to just add on to what you said that analyzing bonds, it's pretty easy and it's not that complicated. And I'd agree with you. And I'd say there are also key metrics for evaluating bonds. For example, the yield to maturity, and the calculation for this is that YTM is the internal rate of return, and if the bond is held to maturity, it factors in the bond's current price, coupon payments, and face value. And the importance of this is YTM allows comparisons between bonds with different maturities, and it provides a comprehensive view of potential returns. And also, you briefly mentioned, I think, that there are some risks, and just to expand on what you said, Arib, and if you look at the risk factors in bond investings, there's the interest rate risk, which is that the risk that changes in interest rates will affect the bond's market value, and bond prices inversely correlate with interest rates. And there's also the inflation risk, which is that the risk that inflation will erode the purchasing power of future bond payments. So yeah, I'd just say add on that information to what you said, Arib, and overall I'd also really agree, and I'd just agree with what you said, Arib. Yeah,
So guys, I have a question. Like in the bond market, there's a huge debate whether you should invest in highly credited bonds such as high-rated bonds, AAA, for example, which are considered the safest, but they offer, I would say not return, but they offer like medium to low yields. But there are some junk bonds which are like triple C rated or and such, but they offer extremely high yield. So is there a strategy that you guys use? Because personally, like many people, including myself, like I'm sometimes confused whether you should invest in the AAA rated bonds, but they offer like 3%, 4% yield. But like the bonds, for example, they offer like 15%, 20% yield. So what would you guys say? Like, which one would you guys invest? Like, or would you guys like divide up your portfolio money like 50% into AAA bonds and 50% into junk bonds and such? So, what do you guys do you guys have any strategies in mind for that?
Okay, so yeah, thank you, Araf, for letting me address our question. And first of all, thank you also, Arib and Shazib, because you guys gave some wonderful insights into the bond market and into the bond world and sphere. And so I guess that sometimes people tend to focus too much on the ratings, and so the bond must be a triple A. But if it's not a triple A, then they won't invest in that bond. I think like just focusing on letters is useless. Of course, letters provided by and the ratings that are expressed in letters provided by the rating agencies are not numbers or letters that have been made up. Of course, they are the result of a lot of analysis, a lot of studies, a lot of research that these rating companies have been doing throughout the time and throughout many years of also their experience in the field. But however, I wouldn't just pose our attention on that because at the end of the day, investing in corporate bonds, which are AAA, or in treasury bonds, sometimes it may yield you a 4%, a 5%. But imagine even a triple A bond, which of course should be the safest bond because is the bond that people think might, of course, repay them regularly, and of course there is even a little amount of risk in that bond too, because it's not 100% guaranteed that they will pay you the principal back, and then of course that throughout the time till the maturity they will pay you the interest that they promised you. Of course, that's why this is the world of investing, because if a financial instrument gave you the 100% confirm that you would earn on that thing, this wouldn't be called investing. But I would also point out that, however, bonds, especially corporate ones, I'm not really focusing on treasury or government bonds. They are even, of course, they tend to be safer than stocks. First of all, because of the limited amount of risk that you have, and also because typically, even when imagine the company goes bankrupt, the debt holders and especially the bondholders will be the first one to be repaid. And finally, I just want to make a last point on the correlation even between bonds and stocks. It's really interesting to see that before we talked about the DCF and we talked about what is called the actualization, and so the discounting of the future free cash flows, and that happens through the WACC. And I must admit that throughout this years that I've been studying what were also the fundamentals, of finance and of investing. Most of the times I've encountered different definitions for the WACC, so the weighted average cost of capital. But I must say that I guess the one that applies more, first of all, to this context, and second, I think the one that even most people will understand is one of the latest definitions that I've read, and so the fact that the WACC basically represents the average return which is expected, first of all, by the shareholder, and so the one who purchased the share, and second, of the bondholder. And so imagine the bondholder has this corporate bond on company A, which is expected to yield him a 4%, and so the bondholder, of course, expects a 4%. And then there's the equity holder, the shareholder, which believes that the company this year will perform an outstanding 15%, or let's say, to put it in simple terms, 14%. So you sum up 14 and 4%, you get 18, you divide it by 2, and that's basically your WACC. Of course, this is really an approximation of what the WACC is, but I guess that it kind of gives the real meaning, the real value behind the WACC, and also the real importance of bondholders in a company.
Yeah, Raffaele, thank you for adding this insightful information. And just to add on to what you said and to answer Arif's question, personally, I think that there are some the strategies that you can use to make the right decision. For example, the yield spread analysis, where you compare the yield spread between junk bonds and highly rated bonds. A wider spread might indicate a higher risk premium, while a narrower spread suggests reduced risk perception, and you have to ensure the additional yield compensates adequately for the increased risk. And also another strategy which can be used is the economic indicators, where you monitor economic indicators like GDP growth, unemployment rates, and corporate earnings. And positive indicators can favor junk bonds, while negative indicators suggest a safer approach with highly rated bonds. And to say what I could personally do and to provide some maybe some scenarios, I'd say one scenario can be the conservative approach, where your portfolio composition would be 80% highly rated bonds and 20% junk bonds. And the strategy here would be to focus on capital preservation and steady income, and to use bond laddering and sector diversification, and to conduct regular credit analysis and monitor economic indicators to adjust the junk bond allocation as needed. And another scenario could be the aggressive approach, where your portfolio composition would be 50% highly rated bonds and 50% junk bonds. And the strategy would be to aim for higher returns while accepting high risk, and we can focus on yield spread analysis and select higher quality junk bonds. And we should also actively manage the portfolio to take advantage of market opportunities. So yeah, if you'd like to add something.
So yeah, I agree with all the opinions that have been shared. I also believe that when value investing, or when investing in a company stock, and when you're value investing, that means that you like the company's financial, you believe that the company has prospects in the future. So if you value invest and buy a company stock, that means that you can also apply that strategy to the bond market. Because if you believe that a company is going to have a very bright future, you can also buy their bonds and profit from both ways. Because if a company has a bright future, that it's very highly likely that they're going to pay back their bonds. So you can also invest in that. And also, for the final minutes, I would also like to talk about the other forms of investing that may exist in some parts of the world, in all parts of the world. For example, because our title today is the art of value investing, stocks, bonds, and beyond. And now let's focus a little bit about the beyond part. And so some of the other areas that investors can invest in could be real estate, and it could be through the form of direct investment, where we could purchase properties for rental capital, or capital appreciation. And for real estate, I believe that we should invest mostly in commercial properties, because they have a high rate of return when compared to private rental properties. And also we could look at real estate investment trusts, companies that own and operate real estate, offering us liquidity and diversification. And there's also other form of investing, such as physical commodities. We can invest in tangible assets like gold, silver, oil, and agriculture products. We could also invest in, you could say, future contracts, for example. And I don't think this is applicable to us to a great extent, but it's likely that the price of oil is not gonna go down in the future. So if we decide to have a future contracts for oil, we could also sometimes make money for it also. So I would also like to hear your opinions. What other forms of investing exist in addition to this real estate and commodities? In what other areas can we invest to diversify our portfolio, in addition to stocks, bonds, real estate, commodities, and more?
So, if you want, I can address the question for first. Well, I believe that certainly there are many other, of course, ways and forms of investing apart from stocks and the bonds. Araf mentioned the real estate and also the futures, but of course there are even what I call the options, the derivatives. And I believe that, however, these kind of instruments are sometimes leveraged, so sometimes are considered to be riskier than even normal investments. And for normal investments, I of course include stocks and bonds. But also, for example, the real estate here in Italy is considered to be one of the safest investments, and most people believe that it's crucial to have to invest in real estate than the stock or the bond market. And this is because, of course, the value of stock, the price of a stock can go down because of many different reasons. But of course, if the share price of a specific company goes down, then you're going to lose a lot of money. But on the other side, when you invest in real estate and when, for example, you buy a house, it's really unlikely, that the value of the house will decrease, let's say, from 100,000 to 30,000. Well, of course, as you guys may know, that is likely to happen for futures, for stocks, and for other investing instruments. And so certainly you got to pay attention to that. And just to evidence a correlation even between, if we want to put it like this, between the real estate market and even the bond market. Most of the times, people who invest in bonds maybe figure the bonds as a way, to earn a passive income thanks to the interest that is being paid, let's say, annually, semi-annually, or quarterly. And this, of course, is another great way even of thinking about real estate too, because when you're renting your house, a house that you have purchased, you of course are earning a sort of passive income, which is of course then taxed, which is kind of similar to the bonds when if you think about it.
Yeah, Raffaele, to just add on to what you said and to add on to Araf's comments and to basically answer Araf's question and to just basically talk about what he wants to talk about and to look at the nuances and to look at the beyond, as Araf said. We can observe, for example, master limited partnerships, MLPs, and MLPs are business ventures in the form of a publicly traded limited partnership, and they're typically found in the energy sector. And the key metrics and considerations here would be the distribution yield, and similar to dividend yield, but typically higher due to partnership structure, and also the tax considerations are vital because MLPs have favorable tax treatments as they pass earnings directly to investors without paying corporate taxes. And the strategy here would be income generation, which is ideal for income focused investors due to high distribution yields, and also the sector exposure, which provides exposure to the energy sector, which can be a hedge against inflation and energy pricing increases. Also, the venture debt is also an interesting factor, in venture debt is a type of debt financing provided to early stage high growth companies that have already raised equity financing. And the key metrics and considerations to look here would be the interest rates, which generally higher than traditional debt due to higher risk. And the warrants would often include warrants to purchase equity, providing upside potential if the company succeeds. And the strategies here would be to complement to venture capital, which provides additional funding to startups without diluting equity, and risk management, which focuses on companies with solid growth prospects and strong venture capital backing. So yeah.
Yeah, Shazib, when Araf first asked his questions, when we are looking into beyond, one person straight came into my mind. So I read a book called Rich Dad Poor Dad by Robert T. Kiyosaki. I think Shazib also knows him. We discussed it in the Finance Club. So one of the things that Robert Kiyosaki talks about is that bonds and stocks are not the only way to make money and to increase your net worth or your wealth. And one of the other beyond factor that I would like to talk about that we haven't really talked about is the futures contracts. Futures contracts, particularly I feel like in the oil industry, is extremely an underrated investment, because let's take crude oil for example, and let's take the company United States Oil Fund, USO. So the United States Oil Fund is an ETF, right? And it tracks the price of West Texas intermediate crude oil using the future contracts, and value investors can actually use these crude oil contracts using the ETFs to gain exposure to oil prices, and they can also capitalize on the oil market, because at the end of the day, oil is a necessity good, and as we learned in economics, necessity goods are not going away anytime soon, and maybe oil in the 100 years or 200 years will be not as commonly used. But I feel like futures contracts, particularly in the oil sector, very good investment opportunity for value investors, and also real estate investment trusts, which are also abbreviated as REITs, I believe. So there are many companies like individual investors and value investors, like if they don't want to take the risk of actually looking at undervalued properties and then flipping it, or then buying it and then selling it at a higher price, they can actually invest in real estate investment trusts, which I think is a safer option. So basically, there are many companies. I think Prologis is a global leader in the logistics real estate market, and it owns and operates industrial properties which are extremely in high demand. And because of this, many investors can actually invest in these trusts and gain money through investing in such. And lastly, I would like to talk about investments that we haven't really touched base, but I believe, like, I have a friend, he lives in New York, and his dad is actually an art collector, and because of that, I was thinking, like, art is an investment too. It might not be as has a high yielding as stocks, bonds, or trust funds, but I feel like fine art, antiques, and collectibles, like, at the end of the day, I feel like they're valuable artworks, and if we actually buy them at auction and hold them for a period of time, they actually appreciate in value. And I think the similar can be said about watches as well, like watches like for $300,000 to $500,000, Rolexes or Patek Philippe, like most people think they're liabilities, but I would actually say that it's an investment, because like watches are one of the investments, like art, for example, like, which appreciate in value. And like most paintings by like Monet or Pablo Picasso have seen significant value increases over time. So like, yeah, like Araf, like, to answer your question, like, stocks and bonds are not the only avenue that value investors can use, but there's also like places like real estate investment trust funds, or arts, and futures contracts that we can use to as a value investor. So like, do you guys have any other like or a market or sector that you think that we haven't covered in beyond, or is that all?
So I think all of the information that you have provided, like all three of you have provided, Raffaele, Arif, and Shazib, covers all of the sectors that possible investors could, invest in. So is there anything that you would like to add before we end our episode for today? Raffaele, Arif, or Shazib?
I just wanted to thank you guys for the opportunity that you've given me to be here and to be able, to discuss with you guys and to share thoughts and opinions about the investing world and the finance one. So thank you very much to everyone.
Yeah, thank you.
Yeah, Shazib, go on, my bad.
I just wanted to thank Raffaele for coming on here and giving us his insightful information. And I'd say that I personally really enjoyed talking about the finance world with him, and I'd say I learned a lot from him as well, and I'd just like to thank him for coming on.
So yeah, again, I would like to thank Raffaele for coming up, for showing up to today's episode, and for contributing his valuable opinions that I believe are very instrumental in understanding the art of value investing. And thank you very much, Raffaele, for coming here. So are there any final words, Raffaele, that you would like to say before leaving our episode for today? Or what do you think about our podcast, and what do you think about the hosts like us? Is there any final words that you would like to say?
Well, so I must say, as I just said, I really enjoy the whole talk, because it's incredible to have the opportunity to share our points of view regarding investing and stocks and bonds with you guys that come from, of course, a different country, and so you have a different background, a different experience, a different point of view, and that's really excellent when talking about investing. And also, I would just like to add one last thing about value investing, and this is another quote that I just remembered from Warren Buffett, which is that basically when you invest in a company, either if it's $10, $100, $100,000, $100 million, you need to think when you buy one share or one piece of share of a company that you're buying the whole business. And so you don't need to just reasoning saying, oh yeah, but this is just a small part, so however it goes, I just might end up losing or gaining a small amount of money, because this is a losing attitude, and this is not, of course, a behavior that a real value investor would embrace.
Thank you, Raffaele, for sharing your opinion. Again, thank you for coming to our episode for today and for discussing your valuable insight. And I would also like to thank the audience for listening to today's episode. And I hope that today's episode offered invaluable insight on the art of value investing in 2024, stocks, bonds, and beyond. And thank you again for tuning in to today's episode. And we hope to see you next week for another very interesting episode with another interesting guest speaker. And so thank you again, and goodbye for today.
Tell me, is you still up? It's 5 a.m. and I'm drunk right now. Tell me, can we still one-on-one, I'm in the zone right now. Tell me, am I still telling you just how I feel right now. You say it's just the drugs, and I know.